Hello students, Assalamu alaikum. Ramzan Mubarak to all my viewers. How are you people? Hopefully you are doing well. Please remember me in your prayers during the holy month of Ramzan. This is our first roza today. So let's start with our paper. Today we have to start AS paper 1. So this is your paper. Okay. AS paper 12, November 2021. This is your paper. 9706, paper 12, November 2021. 1 hour paper, 30 MCQ. Okay. So let's start with your paper. Now here MCQ number 1. Your MCQ number 1 says a trader has prepared financial statement which include unpaid wages to the employees, unpaid wages for the employees. Which accounting concept is being applied? So prepaids and accrueds are part of accrual concept or matching principle. So this is your answer. Okay. Now move to question number 2. On which basis non-current assets will be valued if the business is not a going concern? This means if 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 the owner wants to close the business, so he is not going to uh, value the non-current asset on net book value or because the amount they could be sold for because he is going to liquidate the business. Getting my point clear? So C option is the answer. Now come to question number 3. Now, a business has financial year end on 31st December. It depreciates its machinery on month-to-month basis using straight line method at 10% per annum. It bought a machine cost $12,000 on 1st January 2019 and sold it on 31st March 2020. Which entries related to this machine were made in the provision for depreciation of machinery account for the year ended 31st December 2020? Now, what will happen? First, in 2020, when he's selling, because he's using straight line method, 12,000 multiplied by 10% is 1,200. So depreciation for the year 2020 is, now 2019 is 1,200, 2020 is only 300 because it's using for the first quarter of the year. So that is 1,200 divided by 4, 300. So it means on 31st March 2020 is going to record 300 on the credit side of the provision and 1,500 on the debit side of the provision to remove or provision for depreciation to disposal account. Okay. Now question number 4. A business purchased a non-current asset for $500,000 with an expected life of 20 years. After that time, it was expected to be sold for $100. It was depreciated using the straight line method. The non-current asset was sold after 10 years for $120,000 with selling cost $10,000. So what was the loss on disposal? Very easy question. 500,000 divided by 20, it means $25,000 is the depreciation for 1 year. Okay. No, sorry. Actually, there is scrap value given. 500,000 minus 100,000. So 400,000 is the depreciable cost divided by 20. 20,000 is annual depreciation using straight line method. Cost minus scrap value divided by 20,000 per annum. Now 10 years means multiply by 10. It means total provision for depreciation after 10 years using straight line method is 200,000. Okay. Now machine was sold for 120,000 and 10,000 is your selling cost. So 500,000 is the cost minus 200,000 provision after 10 years. Book value after 10 years was 300,000 minus 120,000 20,000, the selling cost 180,000 plus 10,000, your selling cost, that makes your loss 190,000. Okay. Now come to question number 5. Which items are capital expenditures? Okay. Payment of wages to install a new equipment. Yes, this is capital expenditure. Purchase of new computer for office. This is capital expenditure. Purchase of spare parts for factory. No, it's revenue expenditure. This is also revenue expenditure. Use of factory machinery. So 1 and 2. Answer is option A. Okay, now question number 6. A sale ledger control account showed a debit balance of $15,000. The following errors were discovered. Return outwards 200 had been created in the sale ledger control account. Return outward has nothing to do with sale ledger control account. This is an item of purchase ledger control account, so it's going to be debited again. Okay, to remove the impact of return outward, we have to debit sale ledger control account with $200. Okay. So this is, you have to consider this. So if we debit again 15,000 plus 200 debit, 15,200. What about this? A contra entry purchase control account had been debited in the sale ledger. Contra entry should always be created in the sale ledger control account. If it is wrongly debited, we have to credit it with the double amount. Okay, it's a reversal entry. So decrease, if we credit a sale ledger control account by 800, we have to decrease sale ledger control account by 800 minus 800. Now, a customer created written off in the sale ledger control account. So this has nothing to do with. This has nothing to do with sale ledger control account. This is not an item of sale ledger control account. So the answer is definitely 14,000. Now move. Question number 7. The bank account had a debit balance of 5760 in cash book 5760. Now, amount not yet credited by bank. So we have to deduct minus 900 uncredited deposits, minus 120 bank charges, minus 340 dishonored checks, plus 740 unpresented checks. The answer should be 5140. Yes, B option is the answer. Getting my point here. 5-1. So option B is the answer. Getting my point here. Okay. Now, question number 8. A trader maintains a full set of accounting records. Each one she issues many sales invoices. Where does she record individual sales? An individual sales invoice is recorded in sales journal and sales ledger. Confirm. Don't need to worry about that. Done. Now, question number 9. Brian had a service business which had no inventories. Current asset and liabilities 1st April were as follows: trade receivable, trade payables, bank overdraft. On that date, he sets off a sale ledger balance against purchase ledger balance and made created a provision for doubtful debts of 5%. Okay. Now, a counter entry has been made, so trade receivable is 9,000, 9,400. Okay. And trade payable is 5,700. 9,400 minus 5,700. The answer is 2,700 minus 1,900. The answer is multiply by 3,700. Now, in that case, our trade receivable would be 10,000 minus 600, that is 9,000. 9,400, and accounts payable instead of 6,100, which will become 5,500. Now, Trade receivable, if we create provision for trade receivable 9,400 would be 95%. After reducing 5% doubtful debts, our receivable will be 8,930 minus 5,500 minus 1,900. Answer is 1430. Creditors provision for doubtful debts account for the year included a debit entry representing the change in the amount provided. The rate of provision for doubtful debt has not changed. What might have happened during the year to make this entry necessary? Provision for doubtful debt debit means uh, we decrease provision for doubtful debts. When we decrease provision for doubtful debts, this is very important. When we decrease provision, when our total trade receivable is decreased. Okay? And when, when there is a chance, more chance of doubtful debts when we control the credit risk. These two cannot be responsible for this. So option 1 and 3. Option A is the answer. Now come to question number 11. A trader's income statement records sales $10,000, cost of sales 7,070. The trader has taken goods for his own use during the year, cost 280, selling price 410, but had omitted to record. What effect commission on gross profit? Acha jana. Okay. Now see. Because this we do when owner takes goods for personal use, we do not consider selling price, we consider the cost price. So if you take the cost price, this is 280. 280 is 280 divided by 10,000. That is multiplied by 100, 2.8%. So option could be 1 or D. C and D is not possible. These two can't be the answer. That is my point. C and D can't be the answer. Oh, come on, yeah. C and D can't be the answer. Okay. Now, because we forgot to record the cost of sales, that goods taken up by the owner from cost of sales, we have to decrease cost of sales. When we decrease cost of sales, our gross profit will increase. At this time, when we have not yet rectified the error, it means our gross profit is still understated. Getting my point here. Our gross profit is still understated. So the option should be the answer. Okay. Now remember that the selling price has nothing to do with this inventory taken up. The selling price of the inventory taken up by the owner has nothing to do with this question. Okay. Now William buys radios for $10. He can sell them for $15. So cost price is 10. Selling NRV is 15. Draft still final procedure including value of inventory 1500. His method calculation inventory was correct, but he found that 12 radios could only be sold for $8. It means $4. NRV is 8 and cost price is 10, so $2 the cost is reduced. So 12 radios multiplied by 2, that makes the amount $24. We have to reduce from the inventory. 4 radios are stolen means $40. 4 multiplied by 10, $40. 4 plus 40, 64. So value of inventory should be decreased by 64. So this is the answer. Now, a sole trader has not kept a full set of double entry records. The following information related to his business for the year ended 31st March 2021. क्या है? Sales, inventory, beginning inventory, opening prepaid, expenses paid by check. All goods are marked up by 25%. Here I am giving you a trick which I have learned in ACC when teaching ACC. If markup is 20%, it means margin is 20%. So 2,10,000 multiplied by 20%, the cost of sales is 80%, 2,10,000 multiplied by 80%. Answer 168,000 is the cost of sales. Cost of sales plus closing inventory 18,700 minus opening inventory 17,600 So purchase is 1,69,100. So this is the answer. Option D should be the answer. Getting my point clear? Simple. I didn't do the other calculation. Okay. Now, which statement is correct in the absence of partnership agreement? In the absence of any partnership agreement, the profit is going to be divided among the partners equally. They do not get interest on capital. So, next. X and Y are in partnership sharing profits and losses equally. They have combined capital account balance of 200,000. Z was admitted as a partner not current asset but revalued by 30,000. Okay, total capital of the goodwill was to be valued 20,000 but not to be recorded and retained in the books of account. Okay. Following C's admission, total partners capital account was 270,000. So total new capital is 270,000. Okay. Old capital 200,000 minus 30,000 revaluation. Goodwill, because we do not include goodwill in accounts, so we are not going to consider goodwill here. Getting my point here? So in this question, we will not consider goodwill. Getting my point here? We are not going to consider goodwill. Okay? This goodwill amount is useless. So 40,000 capital has increased, that must be contributed by C. B option is the answer. Getting my point clear? Okay, now come to question number 16. A complete statement of financial position at 1st January 2020 include the following amounts: ordinary share of $5, 800,000, general reserve 80,000, retained earnings 120,000. The following transaction took place during the year ended 31st December 2020. The company issued a further 50,000 ordinary shares at a premium of $1 per share. The company's land was revalued upward by 130,000. Appreciated. Okay. Company paid a final dividend of 60,000. C. What were the total revenue and capital expenditures at 31st December 2020? Now, if we see the revenue expenditure, we have 80,000 journalism plus 120,000 retained earnings minus 60,000 amount of profit, 140,000 is revenue. We don't need to go anywhere. Just one answer is make you capable to answer the whole question. Okay, getting my point clear. A company revalued its premises upward. Which statement about the increase in value? It is an unrealized profit. Yes. Don't need to go for further details. 18. The table shows the equity and liabilities of the company at 31st December 2020. Okay. Ordinary share capital 750,000, 6% debentures, bank loan repayable, bank overdraft, mortgage and building. What is the total non-current liability in the statement of financial position? Please class be careful that this mortgage is no more a long-term liability. Getting my point clear? This is not a long-term liability because we have to pay in 2021, so it has become a current liability. Now only long-term liabilities available: 6% debentures, 150,000 plus bank loan 75,000. Answer is 225,000. The option is the answer. The option. Okay. The non-current assets turnover of a business improved between 2020 and 2020, even though the net revenue was the same for both the years. Plus, one thing, revenues are same, but as non-current asset turnover has increased. So here, this is a locus question in your paper. Be careful about that locus. Now, what we have to do? See, non-current asset turnover. How we can formula, write the formula. Revenue divided by This is how we do. Now see, if revenue is constant and the ratio turnover is increased, it means this amount, this denominator is decreasing. There is only one item available in this question which can decrease the denominator is depreciation. Okay, very important question. Now 20. A business provide for a trade payable, opening inventory, closing inventory. What is trade payables turnover? Trade payables turnover is very easy to calculate. Okay. Now, trade payables is 39,540 multiplied by 365 divided by trade purchases 1,84,600. The answer is almost 79 days. So C option could be the answer. Getting my point clear? The answer is 78 for something to 79. We have to round it. Now, 21. When a company produces 5,000 units of it requires one supervisor. If the production is increased beyond 5,000, we need two supervisors. Step is cost. 22. A business employs 20 workers as production staff. Each worker is employed for 40 hours. And we rate at $7. $7 per hour. So 20 workers multiplied by 40 hours multiplied by $7.8. The answer is 6,240. 20% bonus means 1 multiplied by 120%. Answer is 20% basic rate per hour for each product manufacturer above 120 units per employee. If each employee has produced 145 units, so everybody will get the bonus of 20% of the basic pay. So that is very simple. Okay, are you getting my point here? Okay, now class, when we know okay, this question means analytical. This is, I think, very important question in this Lucas question. What I do, I must solve it for you here. Now, 20 workers multiplied by 40 hours multiplied by 7 point. That would make the cost multiplied by 7.8 multiplied by 6,000. Now, this is the basic. Okay. Now, for bonus, 25 units. Every employee is making 25 units extra. If they are making 145 units and they were supposed to make 120 units. Getting my point? So it means multiply by 25 units multiply by 20 workers. 25 units multiply by 20 workers multiply by 7.8. So what would be the answer? 25 units multiplied by 20 workers multiplied by 7.8. The answer is 3,900 multiplied by 20%. So that would be answer multiplied by 20% is 780. 780. So 6240 plus 780. Oh my god, my calculator is 624 plus 7. Answer is 702. Oh, okay, option is the answer. Now move. It uses absorption costing to set its selling price. Okay. Which overhead costs are accounted for by the use of overhead absorption rate? Only production cost. Production cost is only calculated using overhead absorption rate. Getting my point? Okay. Now come to 24. Now, a business using absorption costing applies a markup of 50% when setting selling price. Each unit of product has a direct cost $60 and a selling price of 150 and requires 2 hours. Absorption rate, oh, very easy. 150 is 150%. 50% is markup. 150 multiplied by 100 divided by 50. The answer is multiplied by divided by 50. Answer is 100. Okay, $100. Out of $100, 60 is your 100 minus 100 minus 60. 60 is direct cost is $40. Basically, our indirect cost. $40 for 2 hours, so 1 hour absorption rate is $40. Okay. Now come to 25. A business at low opening inventory will produce 400,000 units and so on. The following future selling price, variable cost, fixed cost. How would inventory value and profit vary between using absorption costing and marginal cost? In absorption costing, the value of inventory is higher, and when value of closing inventory is higher, the value of profit is also higher. So A option is the answer. Don't worry. Now number 26. Which costs are part of marginal cost of a product? Direct material, fixed production over fixed variable production. So which cost do you think is a part of here we are, direct material, okay. Direct material and variable production. So the option is the answer. Fixed production, which celebration has nothing to do with marginal cost. They are part of absorption cost. So we take it as a period cost of marginal cost. The company provides the following information: variable cost, contribution, fixed production, fixed selling expense. What is the budgeted break-even sales revenue? Oh my God! ना पता क्या है इसमें? हमारी variable cost है 500. Our variable cost is 540,000. That's contribution 360,000. Total sales at this time, according to this data, our sales is 900. If we add variable cost and contribution margin, now 900,000 is our sales. Now 33,60,000, our contribution divided by 900,000, our sales revenue is 40% of 40% of contribution is 40% of sales. Yeah. Okay. Now, what is the fixed cost? 100,000 plus 320,000. Total fixed cost is 420,000. Break even means no profit. We should have equal amount of contribution. Contribution should be equal to the amount of fixed cost. So if we take 420,000 fixed cost as contribution at break even, so it is 40%. So 420,000 multiplied by 100 divided by 40, answer is 10,000. 1,050,000. Now 28. Details for two products made by a company are as follows: selling price, variable cost. Now here what we actually need to do. In this question, the contribution is 11 minus 13 minus 11, $2. In this, why the contribution is $4. Now see, which production mix will maximize the profit? If we produce 200 units, 10,000 units of X, 10,000 multiplied, we will produce revenue 20,000 and Y is 0. In this situation, if we produce 1,000 X, so multiply by 2,000, the contribution would be 2 for X and 36,000. 4 is contribution. Now, if we go for C option, we will produce 2 nines are 18,000 profit for profit for X and 4,000 profits per month. Here we produce 10,000 for X and 20,000. So see where we are more profitable or the options. Question number 29. A manufacturer target profit $80,000 per annum. Last year the business made a profit of 60,000 when 10,000 units of production sold. Contribution was $10. In order to achieve the target profit, the plan is to increase advertising by 10,000 per annum. Variable cost per unit selling price per unit remain unchanged. What will the total fixed cost if this plan? Last year, when things were right, $80,000 was the target profit, but they are only 60,000. So it means 10,000 units multiplied by 10. So that time contribution was 100,000. Okay. Minus 40,000 was fixed cost. So this year, if we increase advertising, 50,000 would be our fixed cost. What are the advantages of budgetary control system? Budget helps to prepare financial statement. No. Budget may be set at easily achievable levels to make the business appear more efficient. Okay, manager become responsible for implementing the department budget. Yes. Now, where budget targets are not met, corrective actions are taken. So D option should be the answer. Okay, so that's all for today. Inshallah, we will come up tomorrow with our new video. Paper 22 AS 11. Inshallah. So hopefully these videos are useful for you guys. If you have any question, any queries, you want to learn something special. I've been solving different topics on my channel as well. So kindly subscribe my channel and take care. Allah Hafiz. Ramzan Mubarak.